I'm Anastasia Amoroso, and this is Beyond 60/40. Today, we're focusing on private equity, and we'll kick off the show with my private market pulse snapshot, and I'll share the one thing that caught my attention this week in private markets. Next, I sit down with Chairman of Goldman Sachs Asset Management, Rich Friedman, to discuss private equity value creation, especially in the current market. And then, iCapital Head of Private Asset Research, Kunal Shah, and iCapital Head of Architect Business Development, Anthony Polemis, discuss how analytics and technology are coming together to enable access to alternative investments. Let's get to it. In today's Private Market Pulse Snapshot, the one thing I'm focused on is this: the value proposition of private equity, especially in the world of higher interest rates. Private equity is the single largest asset class within alternatives. It has $5.9 trillion in assets under management as of the third quarter of 23, and that is still forecast to grow at a 7% annual rate that should reach $8.5 trillion in AUM by 2028. So what is driving this continued growth in private equity? Well, first of all, it's the opportunity set for investors. For example, there are about 11,000 private equity-backed private companies versus just 4,600 public companies listed in the United States. That ratio is 2.4 times, and that has skyrocketed since 2008. And private companies account for 64% of all companies with revenues between 100 million to 500 million. They also account for 84% of companies that have revenues over that $100 million threshold. Now, the reason for such great private company percentage is that fewer companies are going public today relative to the late 1990s. On average, since 2000, there have been 127 IPOs each year versus 307 IPOs on average between 1980 and 1999. This year in particular has been another very slow year of IPO activity, with the number of public listings just slightly higher than last year, and last year was amongst the lowest on record in terms of IPO activity. As companies are staying private longer, the median age of the IPO has risen from 8 years in 1980 to 1999 to average 11 years since 2000. So what does this mean? Well, it means that when companies do IPO, they're likely more mature and their revenues or earnings growth rate is slower than during the time when they were still private. Indeed, the median market value of companies at IPO has risen sharply over the past 2 decades. Now, this in turn means that the returns to investors were likely higher if they invested before the IPO than after it. Indeed, one study shows that the annualized returns 6 months after the IPO were just 2% if the investor purchased the stock at the IPO open trade price. Now compare that to the 40% if they purchased at the IPO offer price, but that is still lower than the 55% annualized return if they entered as a Series C or D investor. So the first reason for private equity growth is this opportunity set. And the second one, which we just talked about, is this value creation in private markets that has been helping private equity managers outperform public markets. But some still question, can this value creation continue in private equity despite higher interest rates? Well, we do find reasons why it could. Take a look, for example, at the breakdown of the GP value creation. There are multiple ways in which private equity managers create value: by buying at a cheap multiple and then selling at a more expensive one, or by applying cheap financial leverage and other financial engineering, or, of course, by operational improvements. Now, it is fair to say that buying low and selling high may not be as lucrative today, given today's higher multiples, and also no more cheap money available that could be fueling those valuations. And of course, applying cheap leverage is also no longer an option, given that 5% interest rates might be here to stay, at least for now. But the focus on operational improvement, using the expert knowledge and know-how to grow revenues and earnings above public companies, that should continue. That should continue to be the value generator for most experienced and skilled managers. Indeed, private equity-backed companies historically delivered higher EBITDA growth rates and higher EBITDA margins than the Russell 2500 counterparts. And typically, that operational improvement accounted for a large portion of aggregate value creation. All in, we do find compelling reasons to believe that growth and performance in private equity will continue. And if history is any guide, skilled private equity managers manage to outperform during a variety of interest rate environments. The focus for investors should be on finding managers with the right mix of skill, experience, and consistency of track record. And that's your one thing in private markets this week. My first guest today is Rich Friedman, chairman of Goldman Sachs Asset Management and member of the management committee, where he leads the development of the firm's alternatives business. Rich also co-chairs asset and wealth management's private investment committees, including growth, infrastructure, and real estate. And of course, prior to his current role, Rich spent 21 years as the global head of merchant banking division investing. With that, Rich, it's great to see you here today.
Thanks, Anastasia. I'm glad to be here.
It's really wonderful to have you here in the studio to talk about the private equity investing environment. And you're the perfect person to do that because, of course, as I mentioned, you spent over 2 decades in private equity investing in private companies across the spectrum. And so I wonder, what is it that you're seeing today for private equity environment? How is it different from the last 2 decades?
So it's a good question. We get asked it a lot. Because, it seemed that, 10, 15 years ago, following the financial crisis and where interest rates were really low, it felt like a very conducive period to invest. Debt was very available, and it seemed like we were, sort of coming out of a tough period. But, and when you look back, you say it must have been an easy thing to make those decisions, which it wasn't. Now we're coming out of a COVID period. And then from the COVID period, there was plenty of stimulus that went on. And now we're looking at much higher interest rates than we really had during that, that 10-year period. So yes, the mathematical equation is different. I actually feel pretty good about the outlook from here because I felt over the last couple of years, we were coming out of this period of stagflation where we're having higher inflation and you really didn't know what was going to go on with the economy. And now I feel as if the economy is at full employment and has been this way for a long time. And I think that's going to continue. I think interest rates are stabilized on the long side at a higher level than people will want. And certainly everyone wants lower rates on the short end. Mm-hmm. But these levels aren't all that different from what I had throughout my career. So I think we're going to be in this period where the economy continues to hum along. And we have to adjust to higher interest rates, but they're not so high. I mean, when I started my career, the prime rate was 17%.
Right. So 4 or 5%.
Doesn't feel that bad. But you would think interest rates should have some effect on the prices paid for companies. And that's what I think is going on right now. There's a little bit of a disconnect between where interest rates are and where multiples are for assets.
That's right. Let's assume that 4 or 5% interest rates are here to stay for some time. And by the way, that's what we had before the financial crisis. And by the way, we did have solid private equity returns during that time. But what about multiples? I hear a lot of concern about the level of valuations. Are they fair? And if we look at some of the transactions that are done, it looks like they have snapped back to pretty high levels, from the 2023 correction. So are private equity valuations fair right now?
Well, you're correct that it seems like there's been a snapback on valuations. It's on a smaller base of deals that have been done, but the prices aren't for the faint of heart. But I think that's not that, I guess it's not that unusual to sort of suspect, okay, of the first deals that are coming out, the sellers have to get what they want. So you have to find the buyer really loving the area that they're going into, for whatever the reason is. But there's still, I don't know what the number is, $1 trillion of inventory owned by private equity firms that ultimately has to sell over the next 3 to 5 years. But I do agree that interest rates being where they are should bring multiples down 2 to 3 points. It's not bringing them down 5 to 7 multiple points. It's not. We're not going back to those periods. And look, I think if we can get some, lower Fed funds rates at some point over the next 12 to 18 months, I think everyone's going to say, great. But we're not there yet.
Well, you think about the value creation in private equity. Some of it typically has come from financial engineering, which it feels like we really can't count on that anymore because if anything, private equity firms are using less debt. Some of it has come from multiple expansion. From what you're saying, we certainly can't count on that anymore. In fact, we might see some multiple contraction. So what does that leave us with? What levers do you pull as a private equity manager to continue to deliver those hopefully outsized private equity returns?
Something that we started doing, I'd say 7 to 10 years ago is really focusing on buying these platforms. Buy companies that have platforms of businesses, whether it's insurance brokerage or different doctors' practices, whatever you want to look at as sort of a platform that you could add on to through acquisitions. And then the operational improvement side, we've built a very big area, a group of 80 former executives, and consultants under a roof that we refer to as the Value Accelerator. And we assign anywhere from 3 to 5 of them to every company that we have. And we work on the various strategies, whether it's efficiencies and cost improvements, or whether it's growth, pricing. A lot of these companies have the same issues. And the thing that we really got, I think, good at over the past 5 to 7 years is technology. We got to bring these companies more forward to what's currently capable on the technology side. And then the hope for AI, what it can do for the operating efficiencies for companies on both expenses as well as revenues, is something that's out there.
I mean, how big of an opportunity set is that? Is that top of mind right now as you think about ways to create value?
I think it's top of mind today. I think the applications today may be on the sales side. It may be on the customer, connectivity side. I don't think we're there yet to point to the operating efficiencies of how we can sort of find, cost improvements by lowering the amount of people we have or things like that. I think it's too early days. I think there's incredible hype with incredible success of creating these large language models. But now there's a period of learning how to apply them and use them. The question is should every company have an AI officer? I don't know.
But that's a great point, is that we are in a bit of a trial and error process right now when it comes to implementing AI and hopefully driving productivity. And of course, that's something that you want to do in private markets versus piloting that if you're a publicly traded company. But I guess to that, the question that I get, Rich, quite a lot is, what about the illiquidity premium in private equity? It used to be, let's say, 300 to 400 basis points. What's the outlook going forward? Do you think it shrinks given how many more people are participating in private equity? What would you say to that?
The question has been asked in prior periods as well. And now we have decades, though, of being able to actually look at what the spread differential is between a public market portfolio of 60-40, or a private equity, portfolio, which, has historically had several hundred basis points or more of, premium return. I think it's justified. I think it's warranted. If it's not, I don't think the industry is going to be able to raise capital like we've been able to raise capital, because if you can't earn those kind of returns, and it's much more that it's private, not the fact that it's locked up, but it's much more that it's private. That's what the practitioners are supposed to do. I'm optimistic that certainly the top 2 quartiles, I don't know about quartiles 3 and 4 going forward, because this is an institutionalized business at this point. It used to be a cottage industry where there were 5 of us. Now there's hundreds.
There's a few more.
Exactly.
And that's a great point about the interquartile dispersion, because when you look at large cap equities, for example, there's not a whole lot of differentiation sometimes within managers. But when you look within private equity, especially growth equity and venture, there's a huge differentiation.
Yes.
And then I'm sure you participate in a lot of the secular growth industries as well, like healthcare, like tech-enabled consumer. So I imagine the revenue growth rates that you're seeing for those companies, earnings growth rates are quite a bit better.
We hope so. I mean, we're focusing more on financial services, which is near and dear to our hearts, and we understand it better. Healthcare, tech-enabled consumer, energy transition. We do look for these big sectors where there's tectonic changes going on. I think that's what you hope to get out of your private equity managers is not only find companies that are different and grow faster, but find sectors that may outpace industries overall. So I would say that the energy transition is a very big area for us, and it has been for the last 3-4 years.
Right. So when you think about now within asset management, the big trend, of course, is for private wealth clients to be allocating to private credit and private equity. So what do you say to a private wealth client as your piece of advice to be successful in private equity? What would you be thinking about?
What I would say is that there's a place in everyone's portfolio for this, and you have to figure out your comfort with it, because you're not going to feel as comfortable that you could put your hands on it. Yeah, you could stare at Google stock and you know what it's trading at, or Goldman Sachs stock. But when you own, it doesn't matter what the asset class is. You just have to. It's put away for long-term, wealth creation, if you will. But you do have to be concerned about, it's not as liquid. I mean, it's truly illiquid. And you won't have the same knowledge or information. But if you have the ability to put some extra capital in for long-term investing, but do it consistently. Don't wake up one day and say, oh my God, next year is going to be fantastic. I'm going to triple my allocation.
Right.
Don't do that.
That's not
Don't
the way
do that.
to
And
do it.
don't sit one out because you'd say, oh, this is going to be a bad year.
Right.
You just don't know. We're dealing with the future. It's hard to predict. And once you make your commitments, you've made your commitments. So you're better off having a steady commitment and make it the right percentage of your portfolio that you work with your advisors on that you're comfortable with. But I believe there's a place for it.
So Rich, the last question is, as you've mentioned, you've been in the asset management industry for a long time and especially focusing on private markets. But as you now chair the Goldman Sachs Asset Management division, what's the focus for you now? What's different? What's most important in asset management right now?
So there are two different things. So what's most important with asset management for the firm is, and it always has to be this way, it's performance. It has to be, we have to deliver high performance returns to our clients, our partners, et cetera, because the ultimate essence of what David wants us to do is grow AUM. You can't do that by just marketing. You have to do that by delivering excellent returns and persistent returns over long periods of time. My personal, it's a little bit of, where I really prefer to spend my time is focusing on the big private equity, the growth capital, more in the equity strategies, because that's sort of been that's been my 40 years in the business.
Right. And obviously, Rich, you talked about the complexity, which is always there. But the way you work through that complexity is you have a discipline, you have a strategic approach. And that's something that certainly makes sense when it comes to private equity and private clients allocating to that. So with that, Rich, you were fantastic to talk to and just the perfect person to dive into all things private equity. So thank you so much for your time and insights today. Thanks for joining us.
Thanks, Anastasia. Great to be with you.
Thank you. Today, in our Spotlight series, we're focusing on how analytics and technology are simplifying access to alternative investments. And I've invited iCapital Head of Private Asset Research, Kunal Shah, and iCapital Head of Architect Business Development, Anthony Polemis, to weigh in on that topic. Gentlemen, thanks so much, Kunal and Anthony, for joining me today.
Thanks for having us.
So Kunal, let's start with you. When you speak to financial advisors about portfolio construction and about including alternatives into the portfolio, what do you hear? What's the feedback? What are the challenges?
You have done this the same as I've done as well. When you go and talk to financial advisors, they're so new to the alternative investment asset class, right? There's a lot of demand because this is one of the few places where you actually can get the enhanced return, better optimized portfolios. But the lack of education and awareness in terms of understanding that and figuring out how to fit that in your portfolio. And so that's the journey that we have embarked ourselves on. How do we help advisors bridge the gap, both from a knowledge perspective, but also product fit perspective? That includes a couple of things. One is understanding how the asset allocation within alternatives work. Once you decide that you want to allocate X% of capital to alternatives, you still need to figure out how much of that goes to private equity, private credit, real assets.
Sure.
And so trying to help them bridge that gap. Second is help them determine products. If you rewind 10 years ago, the number of products available to financial advisors were few. Today, there are 10 times as many funds out there that are available to financial advisors, and their heads are spinning. They're like, which one of this is the right product? The growth in the registered fund space, also evergreen products that we call it, whether it's non-traded BDCs, REITs, 40-Act fund, interval funds, that has just a tremendous growth momentum for the industry.
Sure.
But advisors really need a playbook that is simple. And so our job as we think about what we can do for advisors is simplify the entire process around thinking about allocations from an annual perspective, identify products, and then talk to them in their playbook. They are coming from traditional asset classes. They're used to mutual funds, ETFs, 60-40 model portfolios. We got to create something that is very similar to them, especially for the newer advisors to the alternative asset class or smaller financial advisors who don't have the resources to do all the work themselves.
Right. But Anthony, from your perspective, from the technology side, what are the challenges? What is it that advisors need to make that allocation to alternatives within portfolios?
Yeah, so just as Kunal mentioned, in public markets, models have been really popular for advisors. Similarly, in public markets, advisors have had access to portfolio construction tools for a long time, but there are a lot of challenges as it relates to incorporating now privates into those portfolios. There's a huge selection of private funds that are available to advisors. So being able to actually analyze those funds on a fund-by-fund basis and not just using proxies is hugely important, actually getting down to that manager level, that strategy level, rather than just zooming out. So that's number one. Number two, you want to now incorporate these private funds into broader kind of public market portfolios. It's not just evaluating what fund or funds do I want to buy, but also where do I actually fund those purchases from? How do I draw down from my public portfolio to allocate to private? The third challenge is ultimately this is all about the client. And so as an advisor, I need to think about how does a private markets allocation help my client reach their financial goals, and how does it respect their constraints? And so when we think about analytics, it's not just about risk and return. There's a lot of other considerations, including liquidity, for example. And so constructing that outcome-oriented client portfolio is really important. And so what we've done with Architect is really we've attacked each of those challenges from first principles, and we've delivered a portfolio construction tool that really enables advisors to evaluate funds from their iCapital menu, bring them into portfolios and evaluate them on an apples-to-apples basis with the rest of their public markets exposure, and then ultimately layer in their clients' goals and preferences to determine portfolio alignment. And we're really excited about what that can bring to the portfolio construction.
Well, that is
space.
a very important journey, to go from the traditional 60-40 portfolio to actually envision and sort of touch and feel for what that would look like if you incorporated specific alternatives within the portfolio. And Kunal, to come back to you and talk more about model portfolios, and tell us a little bit more about how are those models created and how do you construct them, and what tools are you leveraging to develop that?
Yeah. One of the focus area for us is outcome-oriented portfolios. So the most basic outcomes that we all use in public markets, we are applying the same to private markets and alternative investments, which is income, growth, and what we call growth and income or balanced. We launched our first portfolio, IMAP, which is a balanced portfolio. And the intention is to leverage the research library. So iCapital private markets and hedge fund research team covers over 80 private markets funds in evergreen structure. These are essentially funds that are available to accredited investors. Second, we wanted to apply statistical framework to that. So leverage the data around historical performance, compare that performance to public markets, distill the performance between alpha and beta components, right? And then do a forward-looking assumption, assuming that the spread of alpha that these managers have delivered in the past will remain. There, we will focus on the highest conviction names out of the 80 plus funds. So we won't include every single fund in the mix, right? The forward-looking assumption then is a framework that we will use to simulate the performance in the future markets, where we use some of the capabilities of Architect. Architect has a lot of sort of quant scientists behind, and our team connects with that team to figure out what is the future-looking sort of projection of those performances and develop the right framework. And then what we try to achieve for our clients is to develop a portfolio that not only gives you asset allocation within alternative investments, so X% goes to real estate, X% goes to private equity, but also find funds that match up with those allocation buckets. Further, we are leveraging technology tools to make the investment experience simple. And then lastly, let's not forget Architect. We are leveraging all of this so that clients can view this in Architect and run all kinds of analytics as well.
Well, what you're highlighting is really the tremendous amount of work that really goes into making that ultimate decision to allocate to specific managers within your alternatives portfolio. And there's a whole lot of dispersion amidst manager performance. And so the fact that you're selecting the managers to potentially improve that model portfolio experience, that's really critical. Anthony, to circle back to you, and let's talk about the integration within Architect of these model portfolios. How can advisors access those models within Architect, and why is that important?
Yeah, I think the combination of the model portfolios and Architect is really powerful for advisors, because as an advisor, you can harness that intellectual capital, that rigor that went into the construction of these model portfolios, and now bring those allocations into your client's portfolio. And so you could simulate perhaps a 10, 20, 30% pro rata allocation of these private asset models into your client's public portfolio, and then really evaluate what the changes are and ultimately have a much more informed conversation with your end client.
So the point of the discussion is how can we make it easier and how can we make it more streamlined? And I really appreciate this combination of Architect with model portfolios in really helping advisors streamline that asset allocation process to alternatives. So thank you very much to both of you, Anthony and Kunal, for your tremendous work, and thanks for joining us today.
Thank you.
Thank you.
Thank you. And we want to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. I'll see you next time on Beyond 60/40.